Well, they might be good for buyers, but falling rates not boosting the shares of Texas-based Frost Bank, down nearly 7% in August. The bank projecting that a Fed rate cut could cost upwards of $1.5 million a month in net interest income. And Morgan Stanley recently downgraded the company on its exposure to floating rate loans, which are higher than some peers. Here to discuss rates and refinancing, Phil Green, Chairman and CEO of Frost Bank. Phil, welcome. Good to have you with us. Let's start with refinancing. Are you seeing an uptick there? And I assume that is actually good for you, even though people may be trading higher rate loans for lower rate loans. You do collect fees on the transaction.
Well, thanks, Tyler, for having me today. We have seen an increase related to refinancing overall, but really to this point, it's been more inquiries on refinancing. If you've got a mortgage that was done, say, a year ago, it makes sense, I think, for them to consider that. And we've been doing some refinancing right there, but I think we're going to have to see rates move a lot more down before we get a big increase in actual refinancing activity.
What would lower interest rates across the board mean for you and your business? We just cited that number that it could cost you $1 million or so, I think it was a month, in lower net interest income.
That's right. As it relates to that one item, there are a lot of factors, though, with regard to our balance sheet, what's coming off in terms of maturities on investments, maturities of fixed rate loans, those types of things, which have to be factored in to see what the overall reduction in interest rates would be. But I think with regard to the change in interest rates and what we see happening right there, I think the most immediate impact of the Fed's movements will be with regard to commercial real estate deals that were underwritten previously. It's going to cause some benefit with regard to debt service coverage ratios. It's not going to make anyone's dreams come true as far as a 25 or 50 basis point cut. It will begin moving them down that road, and I think the expectations that it will improve. I think maybe even more important has been what's happened with the 10-year, and you've seen that move down. And so refinancing opportunities in the commercial real estate markets have really improved. In fact, we saw a deal in Houston that was kind of a fixer-upper multifamily that refinanced long-term at a mid-fives number, which tells me that for really good projects, those are eminently refinanceable once you get to that lease-up stabilization period.
Recently, Morgan Stanley downgraded your bank to underweight from equal weight. One of the things they cited was that you have more floating rate loans than your peers, 59% versus a peer average of 50%. Why are you higher than your peers? Why are you, quote, exposed more in that area? And how would you like to respond to that downgrade that cited that factor?
Well, as we say in Texas, that's what makes horse races. And as relates to why we've got so many floating rate loans, et cetera, it's because we're a relationship bank. We tend to do more C&I lending than our peers, which means we're doing business not just providing capital in real estate markets or maybe energy markets, but we're providing capital to Main Street customers, Main Street borrowers. It also provides, though, a high level of demand deposits that go along with those floating rate loans, and those demand deposits carry a very low interest cost. So I would argue we're a low-cost producer as it relates to overall interest carry and interest payment in our balance sheet. So, but I'll tell you what, Tyler, the most important thing is, to me, is to look beyond what's happening with rates going up or down. What makes our shareholders money long term? That's our growing relationships with consumers and customers. It's our taking market share, providing great customer service, and we're doing outstanding as it relates to that.